In this video, we'll move beyond our first analytical accounting tool, the accounting equation, and introduce a second important tool used by accountants, the T-account. T-accounts help us visualize how business transactions affect individual accounts and show what transactions will look like once they are posted to the general ledger. This tool also makes it easier to understand how debits and credits increase or decrease different types of accounts. By practicing with T accounts, we can analyze transactions more clearly before they are officially recorded in the accounting system. Although experienced accountants often use T accounts mainly for more complex transactions, they're an excellent learning tool because they help build a strong understanding of how the accounting system works behind the scenes. The T account is a visual tool accountants use to analyze how a transaction affects individual accounts before it is officially recorded and posted. Each T account represents one account in the general ledger, with debits on the left and credits on the right. And using T accounts allows us to clearly see which accounts increase, which accounts decrease, and how debits and credits must stay in balance. Before we begin recording transactions, we use T accounts to think through each transaction step by step. This helps reduce errors and reinforces the rule that every transaction must at least have one debit and one credit. Debits and credits are often one of the most challenging topics for new accounting students, so we're going to use a consistent step-by-step approach to analyze every transaction. And trust the process. It will make it so much easier to learn about debits and credits. In step one, we ask a simple question: what accounts increased and which accounts decreased? This is the same type of analysis we did in chapter 2 of our textbook when we used the accounting equation. Now in step 2, we identify what type of accounts those are, whether they are assets, liabilities, equity, revenue, expenses, or drawings. That is also something you're familiar with. In step 3, we'll use the dealer mnemonic to determine whether each account should be debited or credited. The dealer rule tells us that drawings, expenses, and assets increase with debits, while liabilities, equity, and revenue increase with credits. Once we've completed these 3 steps, we're ready to enter the transactions in T accounts. Remember, every transaction must have at least one debit and one credit, and total debits must always equal total credits. Don't worry if this feels unfamiliar right now. We'll practice this process repeatedly with our textbook exercises for Eli's Consulting. In this first transaction for Eli's Consulting Services, Trade & Eli contributes $100,000 cash to start the business. When we analyzed this transaction using the accounting equation, we said that the business's cash increased because the business now has more cash, and monies owed to the owner also increased because the business now owes money to the owner, Trade & Eli. Now in step 2, we ask what kind of accounts are cash and monies owed to the owner. Cash is an asset and monies owed to the owners is part of owner's equity. Okay, so assets and owner's equity are impacted. So now in step 3, we use the dealer mnemonic. Let's find assets first. The graph tells us that assets are on the left side and that assets increase with debits. The business's cash increased, so that means we need to debit cash. What about the second part? Remember that every transaction has at least 2 parts, at least one debit and one credit. The second part is the increase in owner's equity. Owner's equity is shown on the right side of the dealer mnemonic, and the graph tells us that the owner's equity accounts increases with credits. So we credit owner's equity. How do we write this transaction using T accounts? We create a T account for cash with debits on the left and credits on the right. And then we write the transaction ID A and the amount of $100,000 into the debit column of the cash account because we determined in step 3 that we would debit cash. By the way, the transaction ID is an alphanumeric code that companies use to identify the journal entries in the general ledger. The amount of the business owes to the owner also increased. So we learned in step 3 that owner's equity accounts increase with credits on the right side of the T account. We create a T account for owner's equity and write the transaction ID A and the amount of $100,000 into the credit column of the owner's equity T account. And with that, we completed the analysis of our first business transaction with the help of T accounts. For our second transaction, Eli's Consulting Services issued a $5,000 check to purchase a computer and other equipment. When we analyzed this transaction using the accounting equation, we said that the business's equipment increased because the business now has more equipment, and cash decreased because Eli's Consulting paid with a check and the bank account decreased. In step 2, we ask what kind of accounts are equipment and cash. Equipment is an asset and cash is an asset. So now in step 3, we use the dealer mnemonic. The graph tells us that assets increase with debits and decrease with credits. The business's equipment increased, so that means we need to debit equipment. But what about the second part of our transaction? The second part is the decrease in cash. The dealer mnemonic graph tells us that the assets increase with debits and decrease with credits. The cash to decrease, so we need to credit cash. How do we write this transaction using T accounts? Well, we create a new T account for equipment with debits on the left and credits on the right. And then we write the transaction ID B and the amount of $5,000 into the debit column of the equipment account. Next, we find the cash account and write the transaction ID B and the amount of $5,000 into the credit column of the cash account. And we're ready for transaction number 3. For our third transaction, Eli's Consulting Services purchased office equipment on account from Office Plus for $6,000. When we analyzed this transaction using the accounting equation, we said that the business's equipment increased because the business has now more equipment, and the accounts payable increased because Eli's Consulting now owes money to the vendor. In step 2, we ask what kind of accounts are equipment and accounts payable. Equipment is an asset, and accounts payable are liabilities. So now in step 3, we use the dealer mnemonic. The graph tells us that assets are on the left side, and they increase with debits. The business's equipment increase, so that means we need to debit equipment. What about the second part of our transaction? The second part tells us that liabilities increase with credits. So credit, accounts payable. How do we write this transaction using T accounts? We write the transaction ID of C and the amount of $6,000 into the debit column of the equipment account. We don't need to create a new one because we already set one up for the last exercise. Next, we create a T account for accounts payable with debits on the left and credits on the right, and write the transaction ID C and $6,000 into the credit column of the accounts payable T account. Let's move on to transaction number 4. For our fourth transaction, Eli's Consulting Services issued a check for $1,500 to Office Deluxe to purchase office supplies. When we analyze this transaction using the accounting equation, we said that the business's office supplies increased because the business now has more office supplies, and the cash account decreased because Eli's Consulting issued a check. In step 2, we ask what kind of accounts or office supplies and cash. Office supplies is an asset and cash is an asset. So now in step 3, we use the dealer mnemonic. The graph tells us that assets are on the left side and they increase with debits. The business's office supplies increase, so that means we need to debit office supplies. What about the second part of our transaction? The second part is the decrease in cash, which is an asset, and the graph tells us that assets increase with debits and decrease with credits. The cash decreased, so we need to credit cash. How do we write this transaction using T accounts? We create a T account for office supplies with debits on the left and credits on the right, and we write the transaction ID of D and the amount of $1,500 into the debit column of the office supplies account. Next, we find the cash account and write the transaction number D and $1,500 into the credit column of the cash T account. That completes transaction number 4, and we're ready to move on to transaction number 5. For our 5th transaction, Office Manager Sanchez decided to reduce the firm's debt to Office Plus by $2,500. When we analyzed this transaction using the accounting equation, we said that the business's accounts payable decreased because the business now owes less money to Office Plus, and the cash account decreased because Eli's Consulting issued a check. In step 2, we ask what kind of accounts are accounts payable and cash. Accounts payable is a liability and cash is an asset. So now in step 3, we use the dealer mnemonic, and the dealer mnemonic tells us that liabilities are on the right side, and they increase with credits and decrease with debits. The accounts payable decrease, so that means that the account decreases with a debit, and we need to debit the accounts payable account. Next is the decrease in cash, which is an asset, and the dealer mnemonic tells us that assets increase with debits and decrease with credits. The cash decreased, so that means that the account must decrease with the credit, and we need to credit cash. And we're ready to write the transaction into the T accounts. We find the accounts payable T account, write the transaction ID E and $2,500 into the debit column of the accounts payable account. And next we find the cash account and write the transaction ID E and the amount of $2,500 into the credit column of the cash T account. For our 6th transaction, Eli's Consulting Services issued a check for $8,000 to pay for rent for the month of December and January. We previously said that the business's prepaid expenses increased because the business now owns this right to use the property, and the cash account decreased because Eli's Consulting issued a check. In step 2, we determined that prepaid expenses are assets, and cash is an asset as well. So now in step 3, we use the dealer mnemonic. The dealer graph tells us that assets are on the left side and they increase with debits and decrease with credits. The business's prepaid expenses account increased, so that means that this type account increases with debits, and we need to debit prepaid expenses. The second part is the decrease in cash. The dealer mnemonic graph tells us that assets increase with debits and decrease with credits. The cash decreased, and this type of account decreases with credits, and we need to credit cash. We now create a T account for prepaid expenses with debits on the left and credits on the right, and write the transaction ID F and the amount of $8,000 into the debit column of the prepaid expenses account. Next, we find the cash account and write the transaction ID F and the amount of $8,000 into the credit column of the cash T account. Today, we practiced using T accounts to analyze the business transactions of Eli's Consulting. For every transaction, we followed the same process: identify what accounts increased or decreased, determine the account category, and then applied the dealer mnemonic to figure out whether to debit or credit the account. The key rule is to remember that every transaction stays balanced. Total debits must always equal total credits. In part 2, we'll continue with the remaining transactions for Eli's Consulting. By continuing using the same method, you'll get more practice and a better understanding of debits and credits.